Good morning and welcome to Financial Accounting. I believe that today is day 17 out of 30 total classes for the fall 2022 semester. Today we're going to be picking up with chapter 8 and we'll get there shortly, but we should start with the course schedule. So we'll be finishing chapter 8 today. So of course, the chapter 8 exercises should be submitted for grading by the end of the day. We will have completed all of those exercises together in class between Tuesday and then today. Next class day then would be Tuesday. We'll be moving on to chapter 9. So you should be finishing up the chapter 8 problem and submitting that, as well as the chapter 9 pre-quiz. Next Thursday, then we'll finish up chapter 9. Chapter 9 is the third and final chapter for exam 3. So you'll be submitting the exercises on Thursday, the 27th. Then the problem will be due on November 1st. And then our third exam will be that first weekend in November. So it's what, the 3rd to the 6th or something like that. Something like that. So it's on your syllabus. The due date, of course, is in the schedule as well. And I wanted to remind you that I do have a review session scheduled for that exam. It's a couple weeks off yet, but you may, if you're available to attend, you may want to sign up in Starfish and so that it shows up on your schedule. I did in the announcement. I just found like that. There it is. In the announcement from Tuesday's class, I did include all of the dates for the rest of the semester for those review sessions. So the review sessions are going to be 9:30 to 10:30 each week before leading up to that exam period. You can see that the next two are on Wednesdays and the final one will be on Monday, December 12th. That's the last week of the semester. We will be done with class. Officially, we have class on Tuesday, December 13th, but we won't be covering new material. That will be potentially review as well. So actually, maybe it's not a bad idea to have that review session repeated on Tuesday during class time if people want to attend that. We'll talk about that in another month or so. Actually, almost 2 months. So questions about any of that? Remember, when you look in Starfish for these review sessions, they're in the My Courses area under, I think it's called like drop-in review with my instructor or something to that effect. Those are different hours than my office hours. So you only want to sign up for these times, the 9:30 to 10:30, if you're planning to attend the review session for an exam. If you're wanting to meet with me individually, separately about something other than review for the exam, you want to make sure you're looking at my office hours, not at the review sessions. Okay. Questions about anything? Oh, the one other thing I wanted to make sure I talked about on the recording is in Starfish this morning, I completed what are called progress surveys for each one of my classes. So many of you may have seen a note come into your email this morning from Starfish. And the note either said, keep up the good work, or I'm concerned about something. And if you received one of those I'm concerned about something notes, that's really just a signal to you that, hey, there's something going on, whether it's missing assignments, missing class. I know I don't have an attendance policy, but I also know that you're more likely to get the work done and get it done well if you attend class, either on campus or on Zoom. And so if you received one of those I'm concerned kind of notes from me, what I'm looking for then is a note back from you to say, here's my plan. I know I've been missing some assignments, or I know I haven't been in class and haven't been doing the work. but here's how I plan to get back on track. When that happens, I can do in Starfish what's called lowering the flag or clearing the flag, so that it's not hanging out there that, hey, there's an issue with this particular student for this class. May save you from getting a phone call from someone other than me saying, hey, you're having trouble in some classes. Those kind of phone calls come when you have multiple classes or multiple flags that are up at the same time. So Starfish is an early alert system so that we can intervene. I know I told you when 6-week grades were due that the best indicator we have of what your final grade will be is your 6-week grade. And so this is just one more checkpoint. We're now into week 9 of 15 for the semester. And this is just a checkpoint to make sure that everyone is doing okay. And if you're not, that we come up with a strategy or a plan to get you back on track so that you can be successful. So please, if you did receive one of those, I'm concerned about something, notes from me through Starfish, just hit reply and send me a note back and say, here's what I'm going to do. And then of course do it. All right, so if there aren't any questions, I'm going to go to our exercises for chapter 8. And remember, we had skipped exercise 1. We'll be coming back to that by the end of class today. So we've done 2 through 6 together last class. If you were here, you should have those all done. And we're going to pick up with exercise 7. So you should have your chapter 8 exercises open and go ahead to exercise 7. As always, I want to do just a brief recap of what we talked about last time to lead us into where we are right now. So this chapter is on receivables, and up to this point, we have focused mainly on accounts receivable. After we do this exercise, we're going to be shifting over to the concept of notes receivable that we mentioned last class. In particular, our focus in this chapter on accounts receivable is what do we do when we extend credit to some of our customers? We know that we're taking a risk that some of them will not be willing or able to pay us when their bill comes due. And the matching principle says if that's going to create an additional cost for us, that some of our customers don't pay their bill, we need to recognize that and record that cost in the same period that we record the revenues. That's what the matching principle means, that we're matching the expenses with the revenues in the same period. So as soon as we earn the revenues, we have to match against them all of those expenses, even if those expenses aren't actually, we don't even know about them until maybe a future period. We don't know at the time that someone charges puts something on account with us that they're not going to pay. But we have to estimate that some of our customers might not pay. We have to estimate the dollar amount that we think might not be collectible. So in class on Tuesday, what we talked about, and spent several exercises looking at what I referred to as the balance sheet approach or the AR aging method. So we looked at what an aging is. We completed in part an aging for some customers that had been left off that aging. We talked about how to calculate due dates and how to know how far past due an account is. So we did those calculations as well. We completed the aging. We looked at, for each category on the aging, what percentage of those accounts might not be collectible. Those are estimates. We did those calculations and we saw how to record the allowance amount. We talked about that allowance for uncollectible accounts or allowance for bad debt. We talked about that being a contra asset account. So it has a normal credit balance. But we also saw in one of those exercises that sometimes that account actually can have a debit balance. And so we'll talk about today why that might, or how that could happen. Okay. So that's a summary of what we talked about on Tuesday. Anyone have any questions? Anything that you want to, that you're still not sure about from what we did on Tuesday? Okay. So what we're going to be doing in this very first exercise is, as you can see at the top of the screen, entries for bad debt expense under the direct write-off and allowance methods. Now, I explained the direct write-off method on Tuesday, and I told you that that is not an acceptable approach under GAAP. We have to use the allowance method because the direct write-off method violates the matching principle. I also told you, though, that we do use the direct write-off method for tax purposes. And so it's not that it's never used, but that it can't be used on our financial accounting, the annual reports that we produce to share with the public. And so we've talked about already setting aside that value, and I made it clear, I hope, that when I say setting aside value, it doesn't mean we're taking dollars out of our bank account and shifting them into some kind of a savings account or anything like that. What it means is on our balance sheet, we are recognizing in that contra asset allowance account that some of our customers might not pay us in the future. We need to report that expense now, and then when in the future they actually don't pay us, we have a place to write off, God bless you, we have a place to write off that account. And so our first journal entry here on letter A on June 8th, it tells us we had to write off the account of Kathy Quantel, and that was for $8,440. We're asked to use the direct write-off method. What that means is under the direct write-off method, we haven't estimated that expense up front. I don't know when this sale happened to Kathy. It might have been last month. It might have been 2 years ago. But if we're using the direct write-off method, we have not already recorded that expense. And so at the time we write off the account, it would look like this. We are actually going to record the expense at the time we write off the account. Under the matching principle, this is not an acceptable approach. Under GAAP, we can't do that. We would have already reported the possibility of that expense at the time the sale happened. But under the direct write-off approach, we record the expense at the time that we write off the account. And by writing off the account, it means that we are removing it, crediting our accounts receivable. Kathy's not going to pay us for whatever reason, and we talked about last class what that might be. Maybe she's declared bankruptcy, maybe unfortunately she is deceased and did not leave an estate with any assets that we can try to go after those assets to collect on this debt. Maybe we've made repeated unsuccessful attempts to contact her. Maybe she left the area, and we don't have a forwarding address. We don't know where she is. And we've followed through our whole process, and we now know there's no hope of getting that money, or at least we think there's no hope. What happened next? On August 14th, we received partial payment. We received $3,000 as partial payment on the $12,500 that Rosalie Oakes paid us. And then we wrote off the remaining balance as uncollectible. So this sounds like someone, maybe a judge, maybe had said, she's declared bankruptcy. And so we've taken the assets that she has and decided how much each creditor gets. Here's your $3,000. We're discharging the rest of this debt. Do not expect to collect anything more. Again, we're still using the direct write-off method. So we need to show that we received that cash. We did receive $3,000. But that was 3,000 of the 12,500 she owed us. So there's another 9,500 that we're not going to be able to collect. And since this is the direct method, the direct write-off method, that remaining balance on her account, we're going to write off as a bad debt expense. And then again, we're going to remove that total receivable from our balance sheet. October 16th, it says we received the $8,440 from Kathy Quantel. So I don't know what the scenario is here. Maybe she had left the area. Maybe she had been temporarily unemployed and couldn't pay her bill. I have no idea what happened, but we had written off the account, and now here 4 months later, we received payment. So we need to reinstate the account. Right now, remember, we're not showing anything on our books that says she owes us that money because we had written it off. So the first thing we need to do is get that account back on our books. So basically what we are doing is reversing this entry from June 8th. We were a little hasty in writing off that account, so we want to put it back on our books. We are reversing the entry from June 8th. We credit bad debt expense, that removes that expense from our income statement. We debit accounts receivable, that puts her account back on our books, and it shows, hey, she owes us that money again. But the only reason we're doing that is because she actually paid us. So immediately at that same time, we're going to reflect that we did receive that payment. So we show the cash we realized from the collection and that we're paying off that account receivable that we had just set up. In my mind, this is similar to what we talked about for correcting errors in our books that we've explained. We've seen a couple times that there's a 1-step and a 2-step process. This really could have just been 1 step. We could have debited cash and credited bad debt expense. We would have had the same result in the long run without doing 2 separate entries. However, doing it in a 2-step process like this gives us more of an audit trail to show where did that $8,440 come from. It came from Kathy Quantel. So it's not as efficient. It's two entries where one might suffice, but it does give us a little bit better way of tracking where that actually came from. Does that make sense? Next thing, wrote off the following accounts as uncollectible. Again, in letter A, we're using the direct write-off method. So the assumption is that we have not reported any expense. We didn't estimate any of this up front. As we write off each one of those accounts, it says to record as 1 journal entry. So we know for the debit side, we're going to be reporting a lump sum bad debt expense. But for the credit side, we need to actually remove all of these accounts receivables from our books. If we are writing off those accounts, we need to show that each one of those individuals no longer owes us whatever their balance was. So those accounts receivables would have had a debit balance. We need to credit them to zero them out. Whatever they owed us, we are writing that off based on the numbers given in the top part of the exercise. And so how do we know how much we're going to debit to bad debt expense? We need to add up all of those credits, right? We just need to know what do we need on the debit side to make this entry balance so that we have the same dollar amounts debited as credited. And if I added them up correctly, it should be $24,955. And the last entry says, if necessary, journalize the year-end adjusting entry for uncollectible accounts. Well, if we are using the direct write-off method, as we are here in Part A, there is no entry. We don't estimate upfront. We only, and so there is actually an option that says no entry required. If we're using the direct write-off method, we don't ever estimate in advance how much we're not going to collect, how much we're going to write off. We wait until we actually realize an account is not going to be collectible. And at that time, we report the bad debt expense. So that's the direct write-off method. And in letter B, we're asked to use the allowance method. And so we're going to be redoing each one of these entries under the allowance method. And you'll see how we write off an account. And at the end, you'll see how we do the adjusting entry at the end of the period. How value gets into that allowance account in the first place. Okay. So let's start with June 8th. On June 8th, we wrote off that account of Kathy Quantel. So remember, when we use the direct write-off method, we would report the expense at the time we write off the account. When we use the allowance method, we write off the account to the allowance. In other words, we debit the allowance rather than an expense account. We already estimated an expense at the time the revenues were recorded, which, as we said, could have been last month, it could have been 2 years ago. The credit side of this entry is still the same. We need to remove that accounts receivable for Kathy Quantel from our balance sheet. We're writing off the account. We have no expectation of ever collecting that. We need to remove it from our total accounts receivable. The second entry is for the $3,000 partial payment from Rosalie Oakes. So again, the cash part, either we have the cash or we don't. If she paid us $3,000 in cash, we need to report that she paid us $3,000 in cash. Partial payment and a write-off of the remaining balance, the credit is to accounts receivable. And again, that looks exactly the same way it did under the direct write-off method. Just like on June 8th, the difference is rather than recording expense at the time that we make this entry, we write it off to the allowance account. The debit is to the allowance rather than to bad debt expense for $9,500. So you're getting the idea that the difference, God bless you, the difference is really only the way we report that bad debt expense. If we use the allowance method, that bad debt expense is estimated up front, not recorded at the time that the write-off happens. October 16th. So this is where Kathy Quantel actually came back and paid us the amount that we had already written off. So again, the fact that she's, oops, wait a minute. Oh, sorry. The fact that she's paying us, I forgot there were 2 entries here. We have to report that we have that cash. we first have to reinstate the account, debiting accounts receivable. And then when we report the payment, we're going to credit accounts receivable. So again, we're doing that two-step process. The difference is rather than putting, how do I want to say that? Rather than crediting the expense account, rather than reducing the expense, remember on June 8th, we didn't record any expense. We took that 8440 out of the allowance account, and so we're going to put it back in. Just like we discussed under the direct write-off method, that first entry on October 16th is reversing the June 8th entry. It's exactly the opposite. Where there was a debit, there's now a credit. Same accounts, different character, debit versus credit on both accounts. So again, if you compare this entry to what you have under the direct write-off method, the only difference is rather than using the expense account, we're using the allowance account. It does not affect our income statement in the period the write-off happens. It affects our income statement in the period that the revenues were recorded, that the sale took place. Moving on then to December 31st, we're going to write off all of those other accounts. And what do you think is going to happen? Rather than reporting bad debt expense, we're going to use the allowance and then write off each one of those receivables. We need to bring in the dollar amounts above. And then just like here, total those up to know how much the debit side will be. 24,955, whoops. But rather than recording expense at that time, we're simply using up that allowance. We've already set aside value in that allowance exactly for this purpose. When we actually have to write off an account, we're using up some of that allowance that we've already set aside. So all of these entries so far, exactly the same as what we did under the direct write-off method, except rather than hitting the bad debt expense line, we use the allowance for doubtful accounts or uncollectible accounts. And that is a contra asset on the balance sheet. So there's no income statement effect at all of writing off an account under the allowance method. Here's the part that's different. So it tells us to assume that the allowance account had a beginning balance of $36,000 at the beginning of the year. So I'm just going to put a T account on the screen so we can keep track of what's happening in this allowance account. I'm just going to sneak it right in here so that I can then scroll down and we can see what's going on. So allowance, or I'm just going to call it uncollectible accounts. Now remember, you might as well label this just to remind you, just like we did in class on Tuesday. Oops. All right. This is a contra asset account. So it has a normal credit balance. Even though it's listed with the assets, it is supposed to have a credit balance. That's its normal balance. As we saw on Tuesday, and I reminded you in the review at the beginning of class, sometimes this account can actually have a debit balance. And we'll talk about in a second why that might happen. You'll notice they tell us it had a beginning balance of 36,000, but it does not tell us whether that was a debit or credit balance. Because it's not telling us the type of balance, we can assume that it has the normal balance. That would be a credit balance. And so I've recorded that dollar amount on the credit side. But let's see what happened in that allowance account On June 8th, we made an entry, a debit of $84.40 to that allowance. On August 14th, we made another entry, debit of $9,500 to that account. Scroll down here. On August 16th, we had another entry to the allowance account. It was a credit. We were putting that $84.40 back in because Kathy Quantel was actually going to pay her bill. Now, in case you're wondering, if she notified us, I'm going to resume payments on my account and I'm going to pay, I don't know, $2,000 a month for the next 4 months. I'll pay you $440 now, $2,000 a month for the next 4 months until the bill is paid off. She's proposed a payment plan. If we're agreeable to that, we can and should, in that context, reinstate the full account receivable. So it doesn't have to be the way it was here, that we reinstated the whole thing because she paid the whole thing. We could reinstate the whole thing and then accept partial payments and still be tracking that, hey, she still owes us some amount. What happened next? On December 31st, we wrote off that series of accounts and we wrote them off to the allowance. So we debited the allowance for a total of $24,955. So those are all the transactions that happened in this account during the year. So go ahead and find the balance in this account. And I might as well just do this the two-step way. Remember how to balance a T account, add up all the debits. That's called the debit footing. We record that at the bottom of the column. And so I have 42,895 as our debit footing. And then we need to add up the credits. $44,440. Then to find the ending balance, we subtract the smaller footing from the larger footing. And we record the difference on the side that has the larger footing. So 44,000, obviously higher than 43,000. So we know that this is going to have a credit balance. But rather than having $36,000 in there, we now have only $1,545. Everybody good with that so far? That was given in the problem. So right up here, it tells us beginning balance. So, yeah. Okay. So with what we've just done, starting with that allowance amount in there, and we had some write-offs and reinstated an account throughout the year, and we ended up with a balance before we do the adjusting entry, a balance of $1,500 on the credit side. With your understanding of what just happened, I want someone to tell me, how would this allowance account end up with a debit balance? What would happen to make this account have a debit balance? If this account had a debit balance in it, what must have happened? Say that again. More write-offs. More write-offs than we had planned. In other words, we didn't have enough in that allowance account to handle, to cover all of our write-offs. That's exactly correct. That's exactly what would have happened. So on Tuesday, we looked at an exercise that said the allowance had a debit balance of $7,600 before we did the adjustment. What must have happened there is we wrote off more than we've already reported as expense. That's exactly what happened, but how that would happen. So unlike accumulated depreciation, which is the first contra asset account we saw, accumulated depreciation always has a credit balance. It can't have a debit balance. It would never have a debit balance. This account can, at least temporarily. I'm going to say it's not supposed to, but it can happen. So let's see. We're also told to do the last piece. So remember, the last thing we had to do is on December 31st, if necessary, journalize the year-end adjusting entry for uncollectible accounts. And we said when we use the direct write-off method, we don't do that adjusting entry. We're not using an allowance. But under the allowance method, that's absolutely a requirement that we do this year-end adjusting entry. And so I'm going to ask you to do this part, this next calculation on your own. I'm going to pause the recording and ask you to do this, and then we'll restart. So based on what's at the very top of my screen right now, this looks very much like a couple exercises we did together on Tuesday. We have a summary of the AR aging. We can see 5 separate classes there, the dollar amount total in each one of those classes, and what percent of that is uncollectible. So I want you to take this information and calculate how much we need to have in that allowance account at the end of the year. Try that on your own and then restart the recording. Okay, so with the aging that we had, I just did the extensions. We know we expect 1% of this 320,000 or 3,200 to be uncollectible. 3% of the 110,000 or 3,300. It did that for each one of the classes and then added them together. And what I find is that this $47,990 is how much we want to have in the allowance account. Of course, that should be a debit balance. Excuse me. No, pretend I didn't say that. Of course, that should be a credit balance. In other words, in this account that we've just balanced down here in the T account, right now it has $1,545 in on the credit side. We want it to have $47,090. So how do I get the balance to what we want it to be? What I referred to on Tuesday as the target ending balance. We wanted to have $47,090 in there. Why? Because we did the analysis of the aging, and that's how much we project or estimate we're going to need in that allowance account to write off the accounts that we don't expect to collect. So what do we need to do to this allowance account to get it from where it is now, $1,545 up to the $47,090? What do we need to do to that allowance account? We need to credit the allowance account. So I'm going to put that part into our entry right here. How much do we need to credit? How much do we need to credit that account? $45,545. And where did that come from? We already have $1,545 in there. We need to put in this much more to get to the $47,090. And it is at this point that we report that bad debt or uncollectible or doubtful accounts expense. Under the allowance method, the expense gets recorded in the adjusting entry. In part A, the expense got recorded one piece at a time as we wrote off each individual account. But under the allowance method, we don't know whose accounts will need to be written off because we have to estimate in advance before Wade Dolan doesn't pay us. Everybody good? So the last question is, how much higher or lower would Rustic Table's net income have been under the direct write-off method than under the allowance method? So under the allowance method, here's the expense we reported for this year, $45,545. How much did we report in total under the direct charge-off method? Well, let's go up here and add it up. We first reported $84.40, but then we canceled that out down here. So I'm going to not count that one. It'll save me a little bit of calculation. So I'm going to count the $9,500 from August 14th. And then the $24,955 from December 31st. That's a total of $34,455 that we would have reported. $34,455 under the direct write-off method, $45,545 under the allowance method. So the difference between those two numbers, $34,455 under the direct write-off method, $45,545 under the allowance method. So which one's income would have been higher? Yeah, because the expense was lower by $11,000. That means the income would be higher by $11,000. So under the direct write-off method, the income would have been higher by $11,090. And let's think about why that is the case. Do you think that we actually write off fewer accounts if we use the direct write-off method? No, the accounts that we write off between A and B here, the accounts we wrote off were exactly the same. So we wrote off part of Rosalie Oak's account, and then Wade, Greg, Amber, Shannon, and Nikki, all of those accounts got written off under A and B. The difference is in the timing. So when we use the allowance method, we're really forecasting for in the future, what will we need to write off? And so we've properly recorded that expense this year, even though some of those write-offs will likely happen next year or even the following year. And so at this point, you should be comfortable with using the AR aging method as we've done here. You should understand how to do a write-off under the allowance method. It gets written off to the allowance. We estimate the expense in the adjusting entry. And you should understand how the allowance account could end up with a debit balance. Any questions on any of that? Okay. Before we start talking about our next topic here, which is notes receivable, I just want to make a comment about the net sales approach. So I told you on Tuesday, there were really two acceptable ways. And it's up to the company to decide which approach they're using. All of the exercises that we've done up to this point were for the, were related to the AR aging approach because it's more of a two-step process. It's more difficult. Difficult's not the right word. It's more involved. If we chose to use the net sales approach, the calculation is actually quite simple. We would be told, here's the sales. Here's what % of those sales we think is uncollectible. Do the math, X% of the total sales, and then debit that amount to the expense and credit the allowance. It's called the income statement approach or the net sales approach because we simply do one calculation. We don't even have to look at the allowance account. We don't need to know how much is in there. We just multiply the sales or credit sales by the percent that we think is going to be uncollectible, and we report that as expense. That's it. Very straightforward. So what we are going to be doing next, before we start this, any questions? I want to move on if you're not ready. Everybody okay? So what we're going to be doing next is notes receivable. And I pointed out to you on Tuesday that the difference really between notes receivable and accounts receivable is notes receivable usually have a longer time till they're due, and they include interest. And so I told you that we would have to learn the calculation for interest. This is a simple interest calculation as opposed to a compound interest calculation. So here's the formula. Interest equals principal times rate. That's the interest rate. Times time. And we usually just abbreviate this as I equals PRT. So easier to remember that way. I equals PRT, as long as you can remember what the words stand for. Important note, the rate and the time need to be in the same units. So our rate, our interest rate is going to be an annual interest rate. So we need to express the time as the portion of a year. In other words, if we look at this first one in letter A here, it shows, it shows that the term of the note is 120 days. We would not plug 120 in for time because the interest rate is an annual interest rate. So if we use 6% and 120, that would mean 120 years. So we're going to express that as a percent of the year, portion of the year, and we'll see that in our first calculation. So as I told you on Tuesday, usually, typically, notes receivable are going to be current assets for us. And that is always the case as long as the maturity length is less than 1 year. If the term of the note is more than 1 year, you can see that's not the case for any of these. But if the term of the note is more than 1 year, we call that an investment. The interest would still be calculated the same way, but we don't expect payment within the near term, within the year. And so it would be considered a long-term investment for us. Now, we've already done some of the due date calculation. We had to do that, use the similar process when we were calculating on Tuesday, how much past due an account receivable was. We're going to do some more of that here. We're going to do the first couple of these together, and then I will ask you to complete the rest on your own, but during class. So let's start with the first one. We're asked to determine the due date and the amount of interest due at maturity. So the first thing is the due date. Actually, I'm going to show you something just quickly here so you can be familiar with the terminology. It'd be easier if I show you the picture. Why did that not go to where I wanted it? Try that again. That's the one I want. Okay. Ignore my writing on the screen. I don't want to clear that yet. Formula. So this is an example of a promissory note, a very simple promissory note. So when we talk about notes receivable, we're talking about promissory notes. If you've ever played the game of life, you might have seen that term before. I don't know anywhere else other than the game of life that you commonly hear the word promissory in front of notes, but it's a promise to pay later. So those numbered items are the terms that I want you to recognize. The maker of the note is the borrower. It's the person who is promising to pay later. In this case, the maker of the note is Selig Company. They are the borrower. The lender is or the payee is the person who's lending, the creditor, the person who's or the entity that's lending the money. It might be a bank, it might be a company that is extending credit to their customer. So one of the frequent uses, more frequent uses of a promissory note is you already have an account with a company and you're not able to pay it on time. And so you negotiate additional time to pay. And the company says, that's fine, but if we're going to give you extra time to pay, we're going to want some compensation for that in the, thanks, Ashley, in the form of interest. So again, the payee is the lender, the entity that is owed the money. I'm moving over to number 3 then. I can find the number 3 on there. There it is. The face amount. The face amount represents the principal that is being borrowed. In this case, $2,000. We need to know the date that this was effective. That's the date the note was made. We said the maker of the note is the person, the entity doing the borrowing. The date the note is made is also referred to as the issuance date. It's the starting date. And so on this note, it's March 16th. Number 5 is the due date. So we're going to be in our exercise calculating when is this note due, because we know the date the note was made or issued, and we know the term or maturity length. And so we're going to do that calculation. There's number 6, the term, the amount of time that this note is good. So it helps us to calculate when we have to pay back the amount that we borrowed if we're the maker of the note. Now, keep in mind that in this chapter, we're talking about notes receivable. That means that we are the lender or the payee. In chapter 10, which is the current liabilities chapter, we'll be looking at this from the other side. We'll just briefly review. If someone's borrowing, then someone else must be lending. We're the lender here in this chapter because it's the receivable chapter. In chapter 10, we'll look at it from the borrower side. But none of this information changes. We're just looking at the opposite side of the transaction. And then finally, number 7 is the interest rate. So it has to be specified. How much interest are we paying? I've already explained that that interest rate is an annual rate. So this note is only 90 days. That's roughly 3/4 of a year. And so we'd only end up paying 2.5% interest. Did I just say it's 3/4 of a year? I meant 1/4. If I said 3/4, it's 3 months, 1/4 of a year. So we'd only end up paying 2.5% interest. The 10% is 10% for the year, but we're not borrowing for the entire year. So again, those are the terms that you should be familiar with related to notes or promissory notes. Any questions about any of that? Now I'll feel okay using those terms in this exercise. So we're looking at letter A. The date of the note is the issuance date or the date the note was made. The face amount is the principal. That's the amount that's being borrowed. The interest rate is 6%. And the term of that note in line A is 120 days or about 4 months. Shoot, there was something else I was just going. Oh, yes. So there are 2 different ways that notes can be issued. They can be issued with interest included or with interest on top. If you're the borrower, you want the interest to be on top of the note. And that's what we're doing here. It doesn't specify, but that is the typical approach. What does it mean if interest is included? It means that even though it says we're borrowing 100,000, once we calculate the interest, we would subtract that interest and we would receive actually less than 100,000. We would receive 100,000 minus the interest. And so that's what it means when we say interest is included. It's included in that face value. It's subtracted out. We receive, just throwing a number out there, we might receive $95,000. The 5,000 that's missing, if you will, is the interest. And so when we pay it back, we pay back the 100,000. What we're talking about here is interest on top of that face value. So we receive the full $100,000. And then when we pay it back, the maturity value is the 100,000 plus the interest. And as a borrower, for the same interest rate, that's what you would want to have happen. So back to our calculating the due date. Now, I know that if I click on the drop-down list, it's going to be pretty clear to me which one. They're not going to give me answers that are a day or two apart. But I want you to know how to calculate this without having a series of dates to choose from. So let's do this together. We're using, again, that same approach that we used on Tuesday. The note was made on January 5th. We don't count those first 5 days. We don't count January 1st through 5th. We don't count the 5th, even though it's the day the note was made. So how many more days are there in January? 31 minus 5 is 26. So this note will be outstanding for 26 days in January. We signed the note on January 5th. So on the 6th, it's now been 1 full day. On the 7th, it's been 2, and so on. This exercise does tell us to assume that this is not a leap year. So February has 28 days. Remember, we're trying to get up to 120 total. How many days are there in March? Remember what I told you on Tuesday? If you don't know, you need to look it up. April has 30 days. So let me see how many days that is, because we're getting close. 26 plus 28 plus 31 plus 30. That is a total of 115 days. So how many more days do we need in May to get up to 120? 5. And so this note would be due on May 5th. So if you look at that list of options, we wouldn't have had to go through the entire calculation because there was only one choice that was May. We could have just said 120 days, that's about 4 months. 4 months after January is May, and pick the day that was May. But you need to know how to do this without being given that list of options. So don't get too dependent on being given those options. Now we need to compute the interest. So we're going to be using the formula that's still up here at the top of the screen. The interest is the principal, the amount we're borrowing, $100,000, times the interest rate, which is 6%, times the time. And we're told it's 120 days, but we need to convert that days into years to match the interest rate. It tells us to assume there are 360 days in a year. Not sure exactly why they do that, other than maybe it makes the calculation a little cleaner. So we're following the directions that are given in the exercise, even though we know there are 365 days in a year. And so what do you get for the interest? Anybody? 2,000. We're going to owe $2,000 in interest. We're going to owe $2,000 in interest. So when this note matures on May 5th, the maker of the note, the borrower, owes $102,000 to the payee. 100,000 is how much was borrowed plus the 2,000 in interest that has accrued. Everybody good? Okay, let's do letter B together. This is only a 30-day note, and the note was made on February 15th. We're told to assume that February has 28 days in it. So that means there are 13 days of this note outstanding in February. So how many more days do we need in March to get up to the 30? 17. The note would be due on March 17th, St. Patrick's Day. And then we can calculate the interest using that same simple interest formula. When we get to Chapter 11, we'll be looking at how to calculate compound interest, where you add the interest to the principal and then the next month you earn interest or pay interest on the original principal plus the interest from the previous periods. And so the simple interest formula, principal times interest rate times time, and remember to express that as portion of a year. And what I found was that the interest is $100. That makes the maturity value $30,100. If this was an interest included note, we would have only received $29,900 up front, and we'd have to pay back the face value or $30,000 on March 17th. Anybody with questions? Okay, so I'm going to pause the recording and let you try C, D, and E on your own. You can use the check my work button. I'm going to put the interest calculations on the screen, but you should be able to do, and it's okay if you want to just ballpark the due date based on the choices that we have here. So May 19th, 45 days, that would be a month and a half later. So the end of June, beginning of July, we know that's going to be July 3rd of the choices we have. It's okay to do that as long as you feel comfortable with how to do it when you don't have a list of possible options. I'm going to pause the recording, restart the recording once you have finished this exercise. Okay, so there you have the due dates and the interest. If you couldn't get them for some reason, I do have the calculations here on the screen, but I think at least everyone here in the classroom is okay. So I'm going to erase my screen and we'll keep going with our next exercise. So now we know how to calculate due dates. We know all of the ins and outs of promissory notes, at least from the receivable side. So in our next exercise, exercise 9, we're going to look at how do we record these transactions for notes receivable. Oh, sorry, did want to say one more thing about this previous exercise. So this final note that was made on October 19th and then was due on January 17th, if this company uses a December 31st year end, they would have to make an adjusting entry to accrue the interest. The maker of the note would need to accrue the interest expense through the end of the year, and the payee would be able to accrue the interest income. Even though it's not going to be paid until January 17th, the matching principle tells us you need to get that revenue or expense in the correct period where it's earned or incurred. And we're going to see that, how to do that in this next exercise. The following transactions were completed by Interlocking Devices Incorporated, a supplier of zippers for clothing. On December 7th, they received from Unitarian Clothing and Bags Company on account $75,000, a $75,000 60-day 3% note dated December 7th, Pearl Harbor Day. So this is a note rather than account receivable. We know it's a note receivable because it includes interest. What happened here? It says it was on account. So Unitarian Clothing owed money to Interlocking Devices. They owed $75,000. And they said, we're going to pay you, but we need a little bit longer. We need a 60-day extension on our account. And so Unitarian Clothing agrees to pay interest. Interlocking Devices says, yes, we'll accept that 3% interest for the 60-day extension. Unitarian Clothing could not just make this decision on their own. There had to be an agreement between Interlocking and Unitarian that, yes, that's okay. We'll give you an extra 60 days as long as you pay us some interest to compensate us because you've got our money for 2 more months. And so at that time, what was an account receivable from Unitarian for $75,000 becomes a note receivable. It was an account receivable. It's now a note receivable. Why is that important that we reclassify it? Well, one, the fact that it's a note receivable reminds us that, hey, they're going to pay us interest on it. 2, we don't want to continue to track that account receivable, and maybe we're sending nasty grams to Unitarian saying, hey, your account's past due. They know it was past due. That's why they agreed to pay interest on it if we just give them 60 more days. So we want to stop tracking that as having been already due. On December 31st, the note has now been outstanding for how many days? Well, there are 31 days in December. The note wasn't made until the 7th, so that's 24 additional days in December, 24 days that this note was outstanding. And so Interlocking has now earned 24 days worth of interest. On December 31st, we get to make an adjusting entry to record that interest receivable and the interest revenue. How much is it? Well, we need to do the interest calculation. So I'm just going to plug that right in here using that same formula that we used in the previous exercise. I equals PRT. Principal, $75,000. Interest rate, 3%. The T, the time. This is a 60-day note, but as of December 31st, the 60 days haven't passed yet. We haven't earned 60 days worth of interest yet. Instead, we've earned only 24. And they're pretty consistent in this software that they want us to use the 360-day. It does tell us that. And as far as I've seen, they do tell you every single time to use 360 days. So we've earned interest for 24 of those 60 days of the note. We have earned $150. We're recording the interest receivable and interest revenue. The other side of that is Unitarian, the maker of the note, should also at the same time be recording interest expense and interest payable as their adjusting entry. We're then asked to record the closing entry for the interest revenue. So this is just one piece of the closing entry, but it's really just to remind us that at the end of the year, that interest revenue count, being a temporary or nominal count, needs to be zeroed out or closed. So how do we close the account? It had $150 in there on the credit side. We need to debit that account $150. Where does it go? Well, it becomes part of income and it goes to retained earnings. So the closing entries that we learned how to do a few chapters ago, we did one summary entry for all the revenue and all the expense. This is just one little piece of that. We wouldn't do a separate entry for just this one account. But it's reminding you, the reason we have this here, it's reminding you that that revenue, since we recorded it in 2017, when it was earned, it becomes part of our income for that period. Even though we're not going to get paid until the note is due, apparently in February. Another point that you should notice is the interest receivable did not get closed. Why not? Because it's a permanent or real account. It's a balance sheet account. They still owe us that money, just like they owe us the $75,000 that's in the notes receivable line. And so fast forward now to February 5th, that's the date the note is due and the maturity date of the note, and Unitarian is going to pay us the full amount that they owe us. Well, how much do they owe us in full? We already know they owe us $150 from last year. How much more do they owe us? The full note was 360. The full note was for 60 days, right? 60 days. 24 of those, we already recorded the interest. So how many more days? 36. And so the interest that we earn from January 1st to February 5th is what we're calculating now. And that would be $225. Just going to make a note of that here. So we already reported the $150 that was from December 7th to the 31st. They now owe us $225 more for January 1st through February 5th. Everyone okay with what those numbers represent? Okay. So how much are they going to pay us in total? I want to show the cash that we receive. They're going to pay us the principal, $75,000, plus the interest from December, $150, and the interest from January through February 5th. So that's a total of $375 in interest plus the principal. The maturity value is $75,375. They no longer owe us the $75,000, so we need to get that note receivable off our books. Remember, on December 31st, we reported this interest receivable, but now they've paid that, so we want to get that off our books. It's no longer an asset for us. They paid us. And the remaining part is the $225, which represents the revenue that belongs in this year, in 2018. We reported the December revenue in 2017. We're going to report the January and through February 5th revenue, interest revenue in 2018, where it belongs. So now you should be familiar with notes receivable, how to calculate the face value, not how to calculate face value, how to calculate the interest, how to accrue interest if the note crosses over a time period, a fiscal reporting period, how to calculate simple interest, due dates, maturity value, and be familiar with all those terms that we talked about on that promissory note. Any questions on that? Everybody's good? Here are my drawings. So part of what we're doing in this exercise is going to be review of what we've done so far, but there's one new concept in here that we need to cover. So we have 11 minutes left and we need to finish this exercise and then go back to pick up exercise 1. So I'm going to do this somewhat quickly because we've done almost all of this before. On March 29th, we received a $30,000 60-day 5% note dated March 29th from Carrie Platt on account. So we know that that means that she's converting an account receivable into a note receivable. Stop me if I'm going too quickly. I don't want to lose anybody in the process, but I want to make sure we have enough time to finish. Same thing happened on April 30th. We received a $24,000 note. So John Kelly is converting his account receivable into a note receivable. You'll notice that Carrie's note is at 5% interest and John's note is at 8% interest. Why might that be? Remember, we talked about last class that you want to be compensated for risk. So market conditions probably didn't change by 3% in that 1 month. What that probably means is that John Kelly is perceived, at least perceived, to be a higher risk than Carrie. They're both being allowed to extend their account for 60 days, but John's being charged a higher rate of interest because they perceive that he's a greater risk. So what happens on May 28th? That's the day that Carrie should have paid her account, but the note is dishonored. What that means is she didn't pay. Okay? She should have been paying the $30,000 plus interest at that time. She did not pay for whatever reason. And so the company at that point needs to move the value, 30,000, out of notes receivable, and they're going to move it back to accounts receivable. So we're crediting notes receivable and debiting accounts receivable. But remember, Carrie agreed to pay interest. So she now owes that interest as well. And we have to calculate the interest using this simple interest formula. So back to Carrie, the note from March 29th. The principal was 30,000 times the agreed upon interest rate of 5% times 60 days out of 360 days in the year. That's $250 that Carrie now owes in interest. She only agreed to pay that interest for 60 days. So we don't get to carry that forward. We don't assume that she's going to continue to pay that interest. The note has matured, and even though she dishonored it, we need to get it out of notes receivable and move it back to accounts receivable. She still owes us that money plus interest now. Try that same calculation for John Kelly when he unfortunately dishonored his note. And so I found $320 of interest that had accrued on John's note. I added that to the account receivable when we reclassified the principal of 24,000 back from notes to accounts receivable. Now on August 26th, so it went from May 28th to August 26. That's 3 more months. And Carrie comes through for us. She's going to pay the full amount that she owes, which was $30,250, plus interest for the 90 days at 8%. So we need to recalculate the amount that she owes. Let's calculate the interest at 8% for those additional 90 days. So the amount she now owes was, remember, $30,250 because she already owed us the interest. Now she's going to pay us interest on that interest, 8%. And that was for another 90 days. So that's another $605 worth of interest that Carrie has paid us. We're going to report that interest revenue. How much did she pay us in total? The original $30,000 plus the $250 on the note plus another $605. And we're going to remove from the account receivable the full amount that we had put in there back on May 28th, $30,250. So we're pretty happy about that. Even though she didn't sign another note when she dishonored the first one. Sometimes that might happen. She could have come to us and said, I need a little more time. And we say, okay, how about 90 more days? But now we want the 8% interest we were charging John in the first place. And what happens to finish off this exercise? We wrote off against the allowance account the amount charged to John Kelly on June 29th for the dishonored note. So the total amount was $24,320. Original $24,000 plus $320 in interest, and we have to write it off. We write it off to the allowance account and we remove his account from our accounts receivable. For some reason, we know he's not going to pay us. Any questions about that? The idea of how we handle it when a note is dishonored, they still owe us the interest. All right, we have just a couple minutes left, so let's get back to exercise number 1. And back to that slide I was on. Let's go back to exercise number 1. And as I told you the beginning of the chapter on Tuesday, this exercise is how do we use this information to help us make decisions about our company? And so as we're looking at receivables on the balance sheet, and we've talked about that balancing act of wanting to extend credit so we don't lose sales, but also not wanting our risk level to be too high so that we have unacceptable losses. We want to make sure we're collecting from our customers in a timely fashion. And the calculation you see at the bottom of this slide is the calculation we're going to be using in this exercise. So you may want to make a note of that. Accounts receivable turnover is sales divided by average accounts receivable. And what this is going to tell us is how many times a year on average we're collecting in full our accounts receivable. So in the interest of time, let's go to that exercise and do the calculation. Accounts receivable turnover is sales divided by average accounts receivable. We've seen this in a couple other exercises like inventory turnover already. The average is the beginning plus the ending divided by 2. So for 2019, we take the sales of 7,906,000, divide that by the average of 580 and 600,000, which is of course 590,000. And so we get an accounts receivable turnover or just receivables turnover of 13.4 in 2019. Go ahead and do the calculation for 2018 on your own. So that would be 6,726,000 in sales divided by the average of 540 and 600,000, which is 570,000. What do we see? In 2018, we were turning over our accounts about 11.8 times a year. Compared to 2019, we're turning it over 13.4 times a year. That's faster. We're collecting from our customers more quickly. From a liquidity standpoint, that's a good thing. Higher is better. Last thing, 1 minute left. Just like with inventory turnover, the book gives you a more complicated formula than is needed to calculate this days sales uncollected or days sales in receivables. The easiest way to do it is take 365 days and divide by the inventory turnover, or excuse me, the receivables turnover. So 365 divided by 11.8. Round to 1 decimal place, 30.9 days, excuse me, 30.9 days in 2018, and then 365 divided by 13.4 is 27.2 days in 2019. On average, it was taking customers to pay us about 31 days in 2018. They're paying about 4 days faster in 2019. That's a good thing. They're paying us faster. That gets us the cash faster, so we have it to use for other purposes, maybe to buy more inventory, to pay our suppliers, to pay our workers, to pay our taxes or whatever. Okay. Any questions about chapter 8 as we finish up? Everybody's good? All right. Thanks for being here. Have a good weekend. See you next week. Go Yankees. Perfect. So it's up to you. You can come to my office in the health building. You can come here. I don't know if you signed up. You signed up for it. Okay. So if you want to come to the office there, that's fine. Or we